Our moderator for today is David Larson. David is a member of the IVSC's Standards Review Board and a managing director in Kroll's Alternative Asset Advisory Service based in Seattle. So many thanks, David, and now over to you.
Thank you, Richard. It's a pleasure to be with you today, and I'm very happy to be joined by three very knowledgeable people in this space. And we'd like to spend what will be a very quick hour touching on a number of points in the digital asset space. We'll try to level set. We'll get and be able to try to answer as many questions as possible. And we welcome you all today. As Richard said, I am with Kroll. Kroll was formerly Duff & Phelps. We rebranded as Kroll. So if you know us as Duff & Phelps, same ownership, same people, just now under the Kroll moniker. So what I'd like to do is have each of our three panelists introduce themselves very briefly. And Olin, why don't I start with you and then go to John and then Rommel.
Sure. Thank you, David. And good morning, good afternoon to everybody. Delighted to be here today. My name is Alwyn Alexander, and I lead PwC's Asset and Wealth Management practice globally, based in Dublin, but in London this morning or this afternoon. And I also sit on the board of the CFA Society in Ireland, as well as sitting on the Global Council for AIMA. So delighted to be here today.
Hi, I'm John Ward. I'm a managing director at Kroll. I head up the firm's operational due diligence practice, and my involvement largely is by directly meeting with fund managers around the world who are managing funds of digital assets. And it should be an interesting conversation about not only what funds should be doing, but what are they doing.
Thanks, and I'm Rommel Johnson. I'm a partner in EY's Financial Services Valuation Modeling and Economics team here in London. I lead our firm's work in the blockchain and fintech space, valuing crypto assets and blockchain businesses for our clients, for fundraisers, for incentivization, as well as for financial reporting, tax and regulatory purposes. I also wrote EY's paper on crypto asset valuation. If you Google crypto valuation, my paper should be the first result. And finally, I'm a father of 2 young children who often like to photobomb my video conferences, so hopefully they won't make an appearance today.
So thank you all, and Rommel, I think I'll duel with you. I'll try not to have any of my 7 grandchildren pop up behind, but I think I'm going to be okay today. And as Richard said, I serve on the Standards Review Board. I also work with some of the technical matters with fair value in the alternative asset space. I work with the AICPA as part of their task force that wrote the PEVC guide, and I was part of FASB's Valuation Resource Group when they issued Statement 157 and amendments thereto in 2006, 7, and 8. So looking forward to our discussion today. What we will do is we want to spend a little bit of time to level set. We'll just briefly talk about digital asset basics. We'll then spend a little bit of time on accounting considerations. Some of the questions that came in advance highlighted the fact that there may be some disjointedness in how we think about accounting for these types of assets. We'll then get into valuation and then some additional questions, and then try to hit Q&A. So let's go with our first polling question. So as we look, more than half of you, thank you for being honest, have, let's say, little experience or no experience in this area, so you're here to learn. A good number of you are in the service provider. Not too many of you are founders or creators of digital assets. That's, I think, probably to be explained because you're busy trying to see what's happening with the value of your tokens at this point, as opposed to attending this webcast. And a good part look at themselves as investors. And again, some of you are being honest to say that you're actually speculators. So, and we did that slightly facetiously to say, is in this space, is it an investment or is it a speculation in what we're doing? So when we talk about, and again, we'll double back on valuation, but the key question that many people have is what is the value of a digital asset? And What is a digital asset is the other question, but we'll come to that in just one second. And we could stop the webinar now and provide the answer to that question, which is it's the amount that the next person will pay. And that amount that the next person will pay is really what drives this space. And we'll get into it. Now, let's get into that a little bit more. So, but I think most of you want to know a little bit more in detail than just that answer. But if you really want to focus on it honestly, that's the value of a digital asset. So let's touch on some of the basics. Blockchain. John, help me here and just give us the kind of 30,000 feet. What is the blockchain? How does it kind of work? Why is it important in this context?
Sure, David. So the blockchain is the backbone of what we have come to understand is the basis for Bitcoin and other digital assets. Essentially, it's a distributed ledger system that, rather than relying on an institution like a bank or a brokerage firm to keep track of the movements of cash or the movements of securities, it is in the public marketplace, and people can see the ledger, and the ledger is a public display of ownership of assets. So you can quickly see that if I had 5 Bitcoin and I transferred them to you, David, for payment of some liability, that essentially the ledger gets publicly updated, that my ownership of Bitcoin will go down by 5 and your ownership of Bitcoin will go up by 5. And it is that blockchain, which is a series of links to a chain, that's sort of the genesis behind the name, obviously, is each update, each movement, each change is a new link to the overall chain of transactions. And it is the existence of the blockchain that allows people to do due diligence and go back and see historically where coins might have been used or where they came from, illegal activities and things like that. So it is the technological building block of distributed ledger technology. We use it obviously for digital assets, and then it's also used for organizations, for industrials and other organizations that are looking to have a public ledger of their activities, whether it's sales, whether it's development, whether it's manufacturing. It is a broad use concept.
And I think as we think about blockchain, if I go back many, many years ago and I was trying to look at data-based architecture, it's not designed to be, I'll say, efficient. It's designed to be secure and replicable so that you can verify any transaction in the chain. But by so doing, it takes some time. So it's not, let's say, quick, but it is intended to be secure and verifiable. Is that the best way to say it?
Yeah, and just one other thing I'll just point out is obviously there's public chains and private chains. So an organization, Kroll, if there was something that we wanted to do, which was important to us, we could have our own private blockchain for our own uses, which would be visible to the employees of Kroll only in theory. And then there's a public blockchain, which is obviously most of the currencies that people might choose to trade are in the public sphere. So organizations may choose to have a private chain, or the chain could be public. But to your point, yes, it is the idea that, wait a minute, am I looking at the most recent version of that document? How do I know that the data I'm looking at is the most recent data? Through the blockchain, you can validate recency and accuracy and newness and freshness, and it's distributed in a way that everybody can see it at the same time.
And again, blockchain is increasingly used in a number of different areas. When we use the term smart contracts, the fintech sector, we're seeing it in some governments that are using that. That is above and beyond where it's often used in the context of digital assets. And I probably confuse us even by listing digital assets and virtual currencies separately here. But I look at virtual currencies as a subset of digital assets, and we'll again look at that. Now, there's a lot of different regulatory pieces. There's things like forks. There's custody, security. We'll touch on briefly on those towards the end, but a lot of different pieces on the operation of the blockchain. But I want to get a little bit further and say, all right, when we talk about digital assets, what are we talking about? A piece of that is I'll say crypto assets. And within crypto assets, we have cryptocurrencies and we have tokens. when we kind of, maybe we want to just touch on each of these very, very briefly. John, Bitcoins and altcoins and stablecoins, what are they? And often we think about Bitcoin with that name itself, and we have all of the different type of tokens that are currencies that trade, which are we up to thousands of them. Stablecoins are, for lack of a better word, a mutual fund that trades around the quote unquote dollar. And then I'll come into the other types of tokens. But by segregating it like this, hopefully it highlights we're talking about a multitude of different things whenever we say digital assets or crypto assets.
Sure. And Rommel, if you also wanted to jump in here as well, the things that people see, Bitcoin is not the only cryptocurrency. There are lots of different cryptocurrencies. Stable coins tend to be linked to a certain fiat currency. Fiat means the currencies that you and I might use to pay for purchases. So there could be stable coins linked to the dollar. There could be stable coins linked to the euro. There could be, and there are currencies like the yen and others where there is a link so that someone who has yen denominated assets could have a stable coin connected to yen and that type of a thing. And Ramel, do you want to go ahead and dig into some of the other types of tokens and the other things that you guys regularly see in your practice?
Yeah, sure. Thanks, John. So, I guess if we think about the genesis of blockchain and crypto, it sort of came out of the last financial crisis. And, David and John gave us a good sort of overview of what the blockchain is. One aspect that's really appealing to people who work in this space is that having a blockchain removes the requirement of having like a central authority, someone who is holding the information, ensuring the information is correct. Because of the nature of the blockchain, it sort of distributes and decentralizes information and power. And that has a lot of different applications and a lot of appeal. It removes potentially the need for custodians and intermediaries in the value chain of many different types of operations. There's been a lot of excitement, a lot of focus on different types of use cases. And I quite like this visualization because I see the cryptocurrency piece as being very different from sort of tokens and sort of the blockchain and the ability to use the underlying crypto, technology, in just kind of in different sort of scenarios in the real world. Cryptocurrencies have sort of come out of almost a sort of distrust of central organizations and governments. And, there's views that cryptocurrencies will eventually sort of take over from fiat currencies, and views that, for things like Bitcoin, where there's a sort of a distinct number of Bitcoin that can ever be issued, which removes the ability for governments to interfere or, to print money, for example. So there's quite a sort of difference in the sort of cryptocurrencies and the tokens, where just running through some of the types of tokens. Utility tokens are generally issued where there's a project, where it could be a project, for example, for sharing hard drive space, for example, where different participants could offer hard drive space or use hard drive space, and they could use tokens in order to do that. So that's a use case from one example of a utility token. And security tokens are a lot like normal financial securities. So they're probably more similar to what we expect in terms of financial instruments. Asset-backed tokens, they're in some ways similar to stable coins in that they are, either backed by an asset or replicate the movement of the underlying asset price. You then have hybrids, which have different features of different types of tokens. And finally, NFTs, non-fungible tokens. Last year there was a lot of hype. There still is a lot of hype around NFTs. NFTs are really, unlike sort of other tokens, which are typically designed to be fungible. So, one Bitcoin is the same as another Bitcoin. NFTs are designed to be, different, and you'll have different data associated with it, either sort of built into the NFT or linked to the NFT, and they'll give the owner of the NFT the rights to commercialize that, either that token or the underlying asset. And we've seen, over the last year, a lot of, excitement about this space.
So I want to move very quickly back to that. Thank you, Raul and John, but let's touch cryptocurrencies really quickly. Cryptocurrencies can be regulated. In fact, a couple of U.S. congressmen, Congress people today asked for or proposed new legislation to regulate certain type of cryptocurrencies in the U.S. We'll touch on that maybe at the end if we have time. We know that China has looked at them one way. We've looked at other countries that have tried to incorporate them, but it's really looking at them as a form of currency. The difference being it's not backed by a government entity. So a virtual currency, when you really cut through it, it's not insured. It may have some value, but the value that it has is only because people believe that it has value. And Romel, am I saying it too strongly, or I'm not saying it strongly enough? When we really think about cryptocurrencies from a value perspective, is it really that they only have value because people believe they have value?
Yeah, I think that's a fair point, David. I mean, but I would also say that is that different from fiat currency? The fiat currency is traded because everyone else believes a piece of paper is worth something, right, and can be exchanged for real goods and services. And that belief comes from the fact that a government stands behind that currency. We do see currencies failing and inflating and hyperinflating. I think it is. You can look at it very similar to fiat currencies. If enough people believe there's value and it can be used, as a store of value, then it will have value.
And I think, one of the questions that came in advance, and just to touch on it again, it's maybe a much deeper question: is it a hedge against inflation of cryptocurrencies? Again, in this context, it doesn't have the full faith and credit of a government behind it. In many cases, Bitcoin, an example, there's a finite number of coins, so they're not adding any. So that says that, all right, the value goes up and down, not because you're adding supply, it's just because of the underlying demand changes. So there are some differences. There are some similarities.
David, I could just quickly add, for a long time, one of the proponent arguments about digital assets was that they were uncorrelated assets, or they were stores of value, or they were inflationary hedges. I just wanted to point out that there is a convergence within the larger asset management sphere where we're seeing not just crypto fund managers, but we are seeing, let's call them traditional alts, hedge funds and venture capital and others who are also investing in digital asset and venture capital and blockchain technology investments, and therefore there is the two worlds are merging. So therefore, if something hits the hedge fund industry, like a major event that would cause people to liquidate out of the hedge fund industry, it's going to also affect the digital asset or cryptocurrency industry. Perhaps several years ago, they were two industries that were not directly connected. I think we're seeing more and more correlation, more connection. So the idea of them being totally uncorrelated assets is starting to shrink away.
So if we, thank you. If we can go to our second polling question, one of the questions that came in along the way was how many blockchains can there be? And I would argue there can be an infinite number. Anybody who wants to create an individual blockchain can create a blockchain. So there's nothing that stops anybody. And again, there are a multitude of uses. So if we'll see what the answers are to our second polling question. And I think that this will drive us as we kind of start to get in a little bit to the accounting discussion and then the valuation discussion, is kind of why do cryptocurrencies specifically, which again is a subset of digital assets, why do they have value or do that? I mean, I think that point that almost a third of you highlight that there is no intrinsic value. And so again, there's in many cases, there's nothing, or I'll say all cases, there's nothing behind it other than ones and zeros if you think about it down to the binary level. And so it's a really looking at that from that perspective of, do people think it has value? And again, I think, Romo, you made that point that if you're looking at the euro, you're looking at the dollar, you're looking at the yen, it has value, again, because governments stand behind it, but because people think it has value and allow it to be used as a form of exchange. So let's move a little bit further forward. And Olin, we've kind of let you be a little bit silent, but I want you to dive in here now with vigor as we kind of talk about where do these types of digital assets, cryptocurrencies maybe specifically, but all the different types of tokens we're talking about, where do they fit in the accounting framework? And does the accounting framework work or does it need to be kind of what's the pressures to possibly change it?
Sure, David, and thank you. I've been silent in anticipation of this exciting area, but from an accounting perspective, if we think the whole world of digital assets is new and exciting and perhaps a little complex to understand all of the moving pieces, let me add another layer with the accounting because it's not straightforward, just like everything else. So you've gone through, I won't spend additional time on the types of digital assets, except to say that when you're considering the accounting model, it's really important to understand exactly what the rights and obligations are to then determine the nature of the correct accounting. And so, unfortunately, the accounting standards are not fully aligned, but also the definitions are not fully aligned. So in addition to understanding the rights and obligations and really reading the contract of the underlying digital asset that you've acquired or are thinking about acquiring, you also need to think about what type of entity is the acquiring entity, i.e., are you some large manufacturing company? Are you an investment company? Are you a broker-dealer? And that actually will also determine the type of accounting that is appropriate. So what the accounting standard setters have done is sort of go back to the basics in terms of looking at the digital assets and trying to understand where do they fit in terms of the current accounting model definitions. So can you consider them cash or cash equivalents? Are they financial instruments? And I saw that come up on one of the Q&As. Is it inventory, believe it or not, or is it an intangible asset? And so the different things to think about are, first of all, cash is defined as legal tender issued by a government under US GAAP. IFRS doesn't have a definition of cash or currency, but there's similar thinking around the common characteristics for cash. It's legal tender, it's issued by a government body. So if it's not defined as cash, if it won't meet the definition, then you're not allowed to account for it as cash. Now, there can be some instances, and I'll come back to that, where it could meet the definition. So then if you're not going to meet the definition of cash, we look to financial asset. The definition of a financial asset means you have to convey a contractual right. It has to impose an obligation to deliver cash or another financial instrument. And so this is where in the accounting world, investment companies or funds, which we were speaking about earlier, or in a broker-dealer model, you might come to that conclusion that it's a financial asset. And then that would fall into the fair value accounting model, which I think most of us are familiar with. So you come up with a fair value and you mark to market on a constant basis and have your realized and unrealized gains, losses. But it's not that simple. So under US GAAP, if we think about inventory, if you think about, for example, if you're mining digital assets or buying them with an intent to resell, there is the question, and the accounting standard setters have sort of inquired into, should it be classified as inventory? In US GAAP, inventory requires them to be considered as tangible assets. They have to be tangible assets to meet that definition. Under IFRS, it actually doesn't have to be physical. And so there's an argument under IFRS that broker-dealers might look at whether they meet the inventory definition. However, in a broker-dealer instance under IFRS, there is an exemption for fair value accounting. So I think you would get back to the same answer. But then finally, and this is probably the catch-all for everything that's not an investment company or a broker-dealer. So as I say, if you think about large companies that, for Tesla, for example, or any company that decides it wants to buy digital assets, it's actually defined as an indefinitely lived intangible asset. So it's intangible because there's no physical substance. And it's generally then it's of an infinite life because there's no sort of natural end to the life of the asset. So there's a lot to consider and there's a lot to figure out where you fall. What I will say, and just to give a snippet of taking this into reality, is what we hear from a lot of research analysts is when they get the public financial statements of a company like a manufacturing company, if it holds digital assets, very often they are not marked to market. They're not accounted for at fair value. And so many of these research analysts are saying, well, actually, we need to get the details and mark it to market ourselves and make an adjustment to the financial statements to really get a proper picture of the value of the company that we're looking at overall. And so I think this has been presented to the likes of FASB to really question, are the accounting standards giving the right picture, and is it substance over form in terms of falling down through the definitions as opposed to the reality of the investment that you hold? So then if we just move on the slides, I think we have the practice aid. I think I've covered most of this, David, in what I've covered. But this is an interesting one, and thank you to David for putting this slide together. But I know I've covered a lot of technical, and sometimes it makes it a little bit easier to understand if we just quickly walk through an example. So if you fall into the definition of an intangible asset, you're basically required to account for that at cost. And then on a frequent basis, examine for impairment. So if I boil that down, and I'll work through this example in a moment, what that basically means is whatever I pay for the digital asset that I buy today, that's my base, and that's what how I account for it immediately. And then on an ongoing basis, I need to, at least annually, but if there's a trigger event, look for what we call impairment. But unfortunately, impairment only works in one direction. So that means if the value of the digital asset goes down, I need to account for that. So now I need to reduce what I paid for it to this lower value where the value has gone down. But if it subsequently increases in value, I am not allowed to recognize that. And so now you can see why there are some challenges around sort of the accounting framework versus maybe the reality of the asset that's being held. So in this example, I'll go through it very quickly. Company A receives 10 Bitcoins in lieu of goods and services that are provided. The value at the time, as I said, goes into the books. The accounting records as 63,000. When the value drops, you need to mark that in your books. So now the value is only 39,000. But then if the value of Bitcoin subsequently increases again, you need to ignore that from an accounting perspective, and you might disclose it in the notes that the value is different. Now, if that was a fund, an investment company, or a broker-dealer that had fair value accounting, you would note that markup in the books and records. So a really big difference between the treatments, and you can see where some of the challenges arise. So if we want to go to the next. Sorry, David.
So, Ola, I just wanted to say, and I know that there's been some push both to the International Accounting Standards Board and to FASB to kind of relook at where they are. But again, that example, I think, highlights that when you're, what you, I think, articulated with the analysts, that the financial statements kind of don't make sense if you have any significant level of digital assets, of cryptocurrencies, because you're holding them at cost, you're holding them at let's say a lower of cost or market or lower of impaired value. And if the value goes back up, it's like you've got this hidden value there that is not being reflected in the balance sheet. So I understand it. I get it. I see how the accounting standards are made about trying to say, are these intangible assets? What are they? They don't fit, but it feels like the lower of cost or impaired value doesn't really match the need for the fair value. Or because I'm a fair value geek, am I biased?
No, I think I broadly, David, I would agree with you. And we know that FASB have now agreed to take this issue on this year. Now, we don't anticipate a response following their considerations until next year. But as I say, it's a live issue for exactly the reason that we talked about. If you're picking up a set of financial statements, are you getting the right picture about the value of the company you're looking at? And maybe I'll just say, it's a little bit like regulation as well. I think accounting standards, and I hate to admit this as an accountant, but we're not always on the front foot. So often regulation and accounting standards and auditing is always catching up with the innovation that's happening live in the markets. So at least it's being looked at, which is positive. So I think I've covered a lot of this, but just to summarize, maybe when do you use fair value measurements? You use them at initial recognition. So no matter what type of a company you are, the day you buy it, that's the value that you book in your accounts. But the big differential is between the next two bullets is where you're forced to account for it as an intangible. You have to fair value, i.e. mark it down in one direction when there's impairment. Whereas an investment company could mark it up and down, and so that's the big point to make sure that you're keeping in mind. There are some other considerations, David, around fair value that I might just pick out a few in the interest of time to go through. But another nuance is if we think back to that example of the 10 Bitcoins, if you acquired 10 Bitcoins at 10 different points, could it even be 10 different times during the day, you need to consider each one individually from an impairment perspective when you're looking at the valuation or whether you need to mark them down. So for example, you might buy Bitcoin at $21,000 today and another Bitcoin at $25,000 tomorrow. If the value of Bitcoin then falls to 23, the first purchase, which was at 21, you just leave it as it is. But the second purchase, which you made at 25, you now need to mark down to 23. So you can't aggregate and kind of do an average. I own 10 Bitcoins and on average, they cost me X. You need to look at each one individually. I think there are also a lot of things to look at and consider around market participant assumptions. So assumptions that go into the valuations of digital assets, particularly obviously where they're not exchange traded and are at the lower liquidity end. But that's just like any fair valuation. Looking at the market. So what's the principal market? Is there a principal market for a digital asset? Is it traded across a number of exchanges? And, if there isn't a principal market, you need to look at the most active where there's the greatest volume. But again, with digital assets, it's all evolving, and some are, relatively, I'll call it liquid, like Bitcoin, large volumes being traded on a number of exchanges. Others, really may not be traded at all. And so that's obviously a key consideration.
I think you hit it very, very well. And again, it's like when we talk about digital assets, we have to know what type of digital asset we're talking about. In the same way, we have to know what is the accounting framework that we use and whether or not, again, it's this impairment model or whether it is the fair value model. And that is kind of entity specific that drives that. So again, I think the polling question's up, asking you if you were the IASB or FASB, how do you think that these types of assets or instruments should be reflected? 2/3 of you are focused on fair value. Again, that's I think that makes sense. And again, that next highest group saying that the current accounting model, at least on the corporate side, seems to make sense. Again, that's an interesting perspectives in looking at that. So with all of that as background, we really now need to get down in and focus on, all right, how do we think about valuing all of these various types of digital assets? And Ramel, I'll ask you to kind of, as quickly as possible, hit them. In some ways, that's straightforward, and in other ways, it's new. But why don't you kind of lead us through?
Yeah, sure. Thanks, David. I'll run through this quite quickly. I guess I'd start by saying that valuation of crypto assets is a controversial and a subjective area. And I recall, an Economist article from a few years ago saying there's no sensible way to reach a particular valuation for these types of assets. Now, that may be true in some cases, particularly for nascent emerging technologies such as NFTs. But I think we would all argue there's a place for traditional valuation techniques here in this space. And indeed, there are requirements for us to do so, right? From financial reporting, tax, driven, regulatory driven purposes, also for commercial purposes when people are making investments. So how do we think about valuing these assets? It's the traditional valuation approaches we all use and are familiar with it, the market approach, the income approach, the cost approach. We just need to think about the characteristics and the special features of the types of digital assets we're valuing when we apply these techniques. The equation of exchange method refers to QTM, quantity theory of money, and that's an economic view of how you would price currency in a sort of under sort of economic models. QTM is a sort of an economic model that's been around a long time, and whilst theoretically it has applications for crypto, it's very rare to see this used in practice because there's a number of variables in that model that need to be assessed and can be highly subjective. If we go on to the next page, the point here is that the types of techniques that you would use would very much depend on what you're valuing. So for currencies, cryptocurrencies, generally cryptocurrencies are traded and they will have some liquidity, and it's really around understanding how much you can rely on that liquidity on those marks that you can observe from exchanges. For deeply traded, highly liquid cryptocurrencies, there's not very much of a debate around what the value is. You have fairly narrow spreads, and you kind of have a view of what it is from a day-to-day basis. But you need to bear in mind that these are highly volatile assets, right? I mean, any given day, Bitcoin or Ethereum, any of these things will be up and down 5%. So they are highly volatile, and you need to think about volatility when arriving at a sort of conclusion. Security tokens are, as previously discussed, probably the relatively easiest types of tokens to value because they are designed to reflect the features of a security. They're also called equity tokens because often they're just replicating the economics of having an equity stake in a company. And therefore you can use, standard valuation techniques under the market approach and income approach that you'd use to assess the value of the company in assessing the value of the security token. But often security tokens are traded and have pricing, directly observable. So it's the same sort of thoughts around that you would look at for any other traded token or currency that you would consider in coming to a view on value. Utility tokens are a bit more interesting. As mentioned, they are typically, tokens issued backing up a project, and the token will usually give the token holder some utility within that project. It might be, there's a whole bunch of projects being run out of Ethereum. It's very simple to, create new projects and issue tokens that can be used on those projects. It's a little bit more challenging to value, but typically you would have pricing again for utility tokens, which we would look at in the first instance. You can adopt more fundamental approaches to valuation. You could think about the sort of opportunity cost of what that token is trying to achieve. So what is the benefit you as a token holder would achieve from owning that token? If you think back to the example I talked about, storage capacity, distributed storage capacity, the cost of storage capacity would be a great opportunity cost metric for what that token value should be. There's no reason why that token should be significantly more valuable than the alternative best use of using hard drive space. So, a cost or opportunity cost perspective would be, could be quite useful here. The one thing to bear in mind with utility tokens is thinking about the value of the token versus the underlying platform or project. The value of the token really depends on, demand and supply for that token and the services that it's providing and its users. But the platform value is really the value that the operator of the platform will be able to generate over time. And so just thinking about that demarcation of project and token is quite important. For asset-based tokens, we would think about the underlying asset value, but also think about how easy it is to access that, and whether we need to think about kind of liquidity or marketability type issues. We have seen examples of asset-backed tokens that have diverged from the underlying asset price for a number of reasons. And finally, NFTs. So NFTs are going through a lot of volatility at the moment. They've emerged significantly last year. There's a lot of there's a lot of sort of interference with pricing, I would say. So there's a lot of hype around NFTs, celebrity endorsements, and lots of cases of people interfering with the price. So it is something that's very difficult to value fundamentally. You could think about the ability to commercialize the underlying art, but again, that's highly subjective. So again, you look mostly to marks and trades, but just bear in mind that there's a lot of volatility there and a lot of issues with some of the robustness of those underlying marks.
And David, if I could just quickly give a brief commentary of what we're seeing in the market, what fund managers are actually doing around the valuation very quickly. Years ago, they used some type of an aggregation, CoinMarketCap.com or one of the other aggregating organizations to do a VWAP type analysis. And most managers said, we're going to use the value on this particular aggregation site as of a certain time. We're seeing a little bit more movement towards these are the 2, 3, 4, 5, 6 exchanges that we trade on. Some of them are using one exchange saying, I'm going to use the price on Binance, or I'm going to use the price on FTX, or I'm going to use the price on Kraken. Others, if they're using 4 exchanges and they have assets in 4 exchanges, they may actually have 4 different prices for Bitcoin within their portfolios. This is a price for our assets held in this exchange as opposed to a fractionally different price on a different exchange. For those, that would be for the very liquid end. The less liquid end, it could be using bids and offers if it hasn't traded in a fair amount of time, or recent transactions. I have a concern if you're at the illiquid end, token actually exists, but it's not frequently traded. Exactly how managers are pricing them. It is my view that a lot of managers are not doing highly detailed analytics around getting good and accurate prices on less liquid tradable coins. When you move all the way to the very illiquid stuff that Rommel was talking about on the blockchain or VC, pre-ICO, SAFs, things like that, unfortunately, we see a lot of managers holding things for extended amount of time at cost. And regardless of sort of value. So if you bought something, a SAFT, when Bitcoin was at 60,000, now Bitcoin is at half that, closer to 30,000, but people are still holding that particular SAFT investment at cost, it could be argued that price needs to be further looked at to see if the value of the investment has materially dropped in line with the rest of the market. So that's a quick overview. Some of the challenges that we're seeing is, when is it done? Where are they sourcing the quotes, bids, or prices, exact timings and cutoffs to make sure that they're done consistently, the concerns around less liquid tradable assets, and then the illiquid side of the market. Those are just some of the highlighted things that we see, the challenges in the actual moving marketplace.
And that's helpful, John. I want to come back to you with a specific question, but I know you've got a comment too. If I think about IFRS 13 and ASC topic 820, if it's actively traded, means there's sufficient volume and frequency to determine a price. So that's why we say we have to take this exchange price to do it, but we have to be able to access that market. So it's the principal or most advantageous market, but we have to have access to it. And one of the questions I have, Olin, is we trade 24 hours a day in the crypto space. So where do we get to pick the price? Do we get to determine which price during the day we want for our P times Q price?
Well, yeah. I mean, I think typically a fund or investment company will have a valuation policy. So it certainly can't be cherry picking and looking for the best price at the best time of the day and the best exchange around 24 hours. So usually there will be a chosen time, date, as of a day in order to generally in a funds environment to cut your NAV, and you kind of need to stick with that. I do agree though, if you don't have access to exchanges, there's an argument around, well, if I can't access the exchange, then should I be using the price on that exchange? And so I think, again, there's no hard and fast answers. We see some clients, taking liquidity discounts because there isn't the depth or the volume that they're seeing as well. I was going to make a point where we are very focused in this webinar around fair value, which, per the polling question, most people seem to think makes sense. But there is also a lot of complexity around. And if you think about the purpose, particularly if we're thinking about currencies and trying to maybe replace fiat currencies from a transactional perspective, there are a lot of issues. So if, for example, I set up and maybe I'm Tesla again and I want to sell a car and I'm going to accept cryptocurrencies, well, you need to take the value at the time that the contract is signed or, is instigated. Whereas if the currency doesn't actually get moved then for 3 or 4 days, you take on that FX exposure, but you don't get to recognize it in your accounts. So I think there's a lot of developments needed to think about how do we get these currencies actually accessible and giving the right accounting answers when we're starting to actually use them for trading goods and services and hard assets, etc. So I just wanted to add that in because I think we're quite focused on fair value, but there's a lot to think about from a revenue recognition, the timing of that, and then the volatility in the pricing of some of these currencies as well.
And I think that is a very good point. In some ways, it's not dissimilar from the accounting model we have today. That if I'm selling again, use the car example, I'm selling a car. And my reporting currency is dollar, but I accept euros to sell that car. I have to deal with that kind of exchange risk. Yeah. It's exacerbated a bit when I'm in the cryptocurrency, partly because of volatility and movement. I've got to pick timing, and I'm going to have movement before, let's say, from the day I sign till the day I actually receive the coin. And then again, so there's I'll say a good deal of judgment required and policy required in the context of cutoff, for lack of a better word.
Exactly. And I think it's the volatility because the markets are only developing in this space.
So I think we've got, we've touched on, and we could spend another hour or more dealing with some of the valuation issues. We could probably spend the rest of the day talking with some of the valuation issues. But we're coming towards the end. And our objective here was to highlight that at one level, the valuation issues are kind of a little bit straightforward, meaning if it's P times Q, it's P times Q for actively traded, and that there are other techniques that are used and can be used for security tokens and the like that are more traditional. But significant judgment is required, and these types of assets are different. And that's that application of informed judgment that is required. So with our fourth polling question is really trying to look at your crystal ball, and then we want to we're trying to in rapid fire hit a few of your questions, and I want to hit a couple other things too. So again, if you look at your crystal ball 5 years out, many of you think that there's going to be again almost a third. It's going to be kind of the same as today, a lot of volatility, but not necessarily fully integrated. Almost half of you feel like they're going to be fully integrated or substantially integrated into the global economy, which is, I guess, if I look at those first three answers, there's a lot that feel like these digital assets are here to stay. So what I'd like to do, and before we hit a few of the final things, is in many ways I don't want to lose sight of valuation, but in many ways, the valuation side of digital assets is the easy side. And I don't know if all of our panelists agree, but John, I want you to touch on some of the other issues or risks that exist with digital assets that maybe are as critical, or if not more critical, than how do we come to value?
I'll just quickly touch on these as time is short. Obviously, the asset existence. How do we know that a particular organization owns what they say they own? You can validate ownership on the blockchain, but again, that's if everybody had to go to the ledger to validate that somebody owns what they say they own, that seems to be a bit technical and a bit outside of normal transactional processes. But in the world of the funds business, obviously there are fund administrators, there's custodians, and there's others that we can look to validate existence and ownership. They're imperfect, but it's a good move. Obviously, sometimes there's changes. So when I could have it on a cold wallet and I am in full control of that and I'm in custody of that, now if I choose to sell it, I move it to an exchange. Well, the exchange is now in custody of that asset. And like it or not, exchanges are where hacking seems to become most prevalent and is where they're at the greatest risk. And that's a key area of due diligence about the risk, ownership, and control of the assets. Counterparties, obviously, there's the possibility of a failure. We saw the Terra Luna event. Obviously, they're not a counterparty. They are an asset, but they're the Anchorage protocol, and there's some other types of interconnected things that put great risk and understanding of counterparty risks, interconnectivity between counterparties and exchanges. And last is service providers. Many of the service providers that we see in the space are not the big four accounting firms. They're not the most recognized banks and brokerage organizations. They're not the most recognized custodians. So therefore, there is a requirement to generally do a deep dive into understanding service providers and custodians that exist within this space that perhaps can be viewed a little bit more lightly if someone sees Goldman Sachs, Morgan Stanley, Merrill Lynch, they have a sort of a feel of their solidity. If you see a name you've never seen before, you need to do more work to understand what is that organization and can I trust in what they're doing.
Well, and come back to you in this same context. When you think about it from the audit perspective, is there any of these issues that is more important than the other? In other words, when I think about value, I feel like we can come to a reasonable basis and reasonable judgments on value. It becomes a little bit more difficult, and thankfully I have let's say hung up my auditor shoes a couple of decades ago. But thinking about existence and ownership, if I'm an auditor, it feels like it's really hard.
Yeah, absolutely. David, and that's probably where most of the audit effort goes, particularly if you're talking about cryptocurrencies where they are exchange traded and you can get a good way of the way there in terms of valuation. From an existence perspective, most of the blockchains will have what they call an interrogator tool so that you can try to interrogate the chain and make sure that you're comfortable with it. But we would always recommend not just relying on one tool. So each digital currency producer, call it, has their own interrogator tool for their blockchain. We'd recommend using a number of interrogator tools so that you can kind of triangulate and make sure. And then the biggest issue around ownership is the private key generation. And what we do find, unfortunately, is that, in their enthusiasm to invest, very often that's overlooked around the security for the generation and then the maintenance of the private key, because without the private key, everything should be locked up and safe, right? But if you don't have, really robust security around that private key, that's an area. And as John said, this area is evolving, it's growing, it's changing very quickly, and we are finding clients sort of jumping into investing in some of these digital assets without having the appropriate control and framework in place to address both existence and ownership.
And I think it is an interesting a space all the way around. There's lots of questions. I think we're seeing just the start of what I expect an avalanche of lawsuits, of litigation surrounding. I've already been approached to be an expert witness. I know John's been approached to be an expert witness in certain aspects of where people have seen a loss, and whether that be on the security side. When I say security, the being able to know that you have that, and as opposed to security like an SEC security. But so there's a lot of different pieces that are happening. We've only got a minute or so left. We've tried to answer most of the questions. I want to hit one real quick, and then maybe ask for 15 seconds from each of you, kind of your view of the future. But if we think about, there's been a good number, I'll summarize, several questions came together about, given the risk, given the volatility, should we focus on conservatism? Should we be conservative in our value? I think that, at least in the financial reporting fair value world, conservative values have come to mean purposely understating. So I would argue we should be prudent, but we shouldn't try to understate the value, that we still have to, even where judgment's required, we need to value based on what a market participant, how they view it. And we shouldn't be too high, we shouldn't be too low. We need to come to a judgment that, again, is prudent. The quick question, and John, I'm not sure if it's you or Rommel, the SAFs. What is a SAF and how do we value them in 30 seconds or less?
Okay. A simple agreement for future tokens. What essentially you're thinking that you've put an agreement together, you're investing a certain amount of money with the expectation of receiving tokens at some point in the future. Some, may liken it to a venture capital type of investment or something, but it is an agreement for future tokens. The tokens are not in possession yet, but it is prior to them going into the public markets, and they tend to be valued similar to a venture capital investment.
So we're at time. I'll turn it back to Richard in just a second, but I would like 10 seconds or less for each of you. If you were giving a gift to children or grandchildren, would it be cryptocurrency? Yes or no? John?
Yes.
Ramo?
I'd say yes, maybe something in the Web3 space where there's a lot of investment, a lot of excitement. There could be some big things emerging there.
Olin?
As an accountant, I would also say yes, believe it or not, but I think not today, in a couple of years when the infrastructure and the regulation has really been embedded, because I just think there's, I hate to say it, too many cowboys out there still.
So the reason I asked that question is I did it for my grandchildren, and so far I've been able to turn $1 into 50 cents. So we'll take that as for what it's worth. And again, I appreciate all of you, and Richard, back for your participation, and Richard, back to you.